What is decentralized finance, or alternatively known as DeFi? DeFi is an emerging financial technology based on secure, distributed ledgers similar to those used by cryptocurrencies. The Securities and Exchange Commission, the SEC, and the Federal Reserve set the rules for centralized financial institutions like banks and brokerages in the US, where customers go to directly access capital and financial services. By giving people access to peer-to-peer digital trades, DeFi threatens the centralized financial system. DeFi eliminates the usage fees that banks and other financial institutions impose. Anyone with an internet connection can use DeFi, and users can store money in a safe digital wallet and transfer money quickly. Some key lessons are: decentralized finance eliminates third parties and centralized institutions from financial transactions by using developing technologies. Stablecoins, software, and hardware that supports the creation of applications are the elements that make up DeFi. DeFi's regulatory framework and infrastructure are always changing. Decentralized v. centralized. Decentralized finance is distinct from conventional centralized banking and financial institutions. In centralized finance, banks and other third parties hold the funds and enable the transfer of funds between parties. Each party charges a fee for its use. An acquiring bank receives the card information from the merchant and passes it on to the credit card network to complete the credit card transaction. The network authorizes the charge and asks the bank for payment. Because retailers typically have to pay for the usage of credit and debit cards, each link in the chain is a paid-for service. Centralized finance oversees all financial activities, including loan applications and local bank services. By enabling individuals, businesses, and merchants to perform financial transactions through new technologies, decentralized finance eliminates middlemen. DeFi makes use of connection, software, hardware, security protocols, and peer-to-peer financial networks. People can lend, trade, and borrow using software that logs and validates financial transactions in distributed financial databases from anywhere there is an internet connection. A distributed database collects and aggregates data from all users and utilizes a consensus process to verify it, making it available from different locations. By enabling anyone to utilize financial services wherever they are, regardless of who they are or where they are located, decentralized finance eliminates the necessity for a centralized finance model. Through individual focused trade services and personal wallets, DeFi applications provide customers more control over their finances. The blockchain technology that cryptocurrencies employ is used in decentralized finance. A distributed and secure database or ledger is referred to as a blockchain. The blockchain is operated and transactions are handled by programs known as dApps. The blockchain records transactions as blocks that are later confirmed by other users. If all of these verifiers concur on a transaction, the block is closed and encrypted, and a new block is made with details of the old block inside of it. The term blockchain refers to how the blocks are chained together by the data in each succeeding block. There is no way to edit a blockchain since changes to information in earlier blocks always have an impact on later blocks. This idea, coupled with other security measures, give a blockchain its security. One of the main tenets of DeFi is the use of peer-to-peer financial transactions. When two parties agree to exchange cryptocurrencies for goods or services without the involvement of a third party, this is known as a P2P DeFi transaction. In DeFi, peer-to-peer lending can satisfy a person's desire for a loan. An algorithm would connect peers who concurred with the lender's terms, and a loan would then be granted through a decentralized application or dApp. P2P payments are made and processed in the same way as blockchain transactions. A DeFi platform is accessible to anyone with an internet connection, and transactions can take place anywhere in the world. Using DeFi network, any two parties can directly negotiate interest rates and make loans. Smart contracts recorded on a blockchain are open for everyone to study, and records of transactions that have been performed are also available, but they do not identify your name. Because blockchains are immutable, they cannot be altered. DeFi platforms are independent of any centralized financial institutions, making them impervious to failure or misfortune. DeFi protocols' decentralized structure significantly reduces this risk. The world of decentralized finance is always changing. It's currently unregulated, and its ecosystem is full of frauds, hacks, and infrastructure errors. The current legal framework was developed with the idea of several financial jurisdictions, each with its own set of regulations. The potential of DeFi to conduct borderless transactions raises crucial issues for this kind of regulation. DeFi wants to undermine the widespread usage of centralized financial institutions and middlemen in all financial transactions. The cryptocurrency Bitcoin is not DeFi as much as it is a component of it. DeFi is being created to use cryptocurrencies in its ecosystem. Total value locked, or TVL, is the total amount of all cryptocurrency staked, loans made, deposits made into pools, and other financial transactions made across the whole DeFi network. It may also be used to donate the whole value of a particular cryptocurrency, like Ether or Bitcoin, which is used for monetary transactions. DeFi poses a threat to the current centralized banking system. DeFi encourages the usage of peer-to-peer transactions by eliminating the fees that banks and other financial institutions charge for using their services. Thanks for watching. Please subscribe for more.